This is exactly what happened last time when Trump was in power in 2017. But where the big game is to be played is China.
No other president's taken it on. I had to take it on the last time.
Bitcoin is plunging, down nearly 30% from its all-time highs, as tensions reignite between the US and China. The trigger? A renewed trade war under Donald Trump's leadership. And now, breaking news, the conflict is heating up fast. The White House just announced a jaw-dropping 104% tariff on Chinese imports, set to kick in at midnight if China doesn't come to the negotiating table. Things are escalating and fast.
Look, I just spoke to the president about this, and he believes that China wants to make a deal with the United States. He believes China has to make a deal with the United States. It was a mistake for China to retaliate.
For context, this all started just a week ago when the US rolled out one of the steepest trade tariffs in recent history, a 34% levy on Chinese goods. That alone sent Bitcoin tumbling another 15% almost instantly. China hit back, and now the US is doubling down, more than tripling the tariff rate. But here's the twist. Most people don't really grasp what's actually going on behind the scenes. I do. And in today's episode, we're peeling back the curtain, because not everything you're seeing is what it seems. Some of this political back and forth, it's theater.
The agreement with China will be, you will agree to tariff terms, we will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem.
Even major tariff advocates like Anthony Pompliano, yes, that Pompliano, are sounding the alarm. He's known for being bullish on tariffs, yet even he's warning this is escalating way too fast. A 104% tariff? That's not just aggressive. It's potentially destabilizing. Hopefully, we see things settle back to more manageable levels, somewhere in the 5 to 10% range. But here's what really matters. Bitcoin's crash is just the surface level story. The deeper play, it's all about the US dollar. And right now, the dollar's value against a basket of major global currencies is plunging. Some are starting to believe this might be part of Trump's strategy.
He wants to crash the dollar.
What? He wants to crash the dollar?
He wants to crash the dollar. America has historically been in the difficult position that because it is the currency of choice, people buy dollars and they store dollars. So people sell stuff to America rather than buying stuff from America so they can get dollars into their own country. He wants to reduce the power of the dollar so that people stop doing that. And so because the dollar is weaker, people buy more stuff from America because it's cheaper.
Why? Because a weaker dollar means one thing. Foreign buyers can scoop up US goods at a discount. That surge in demand can stimulate domestic growth. It's counterintuitive, but it's a playbook that's been used before.
But these are the reasons why, to actually answer the question, I don't believe he will reverse. He's expecting the revenue. This is what he thinks is going to happen and wants to happen. And the long-term goal is that in 2-4 years' time, factories are opening and people are saying, well, that wasn't so bad after.
In fact, we've seen Trump run this exact strategy, though on a smaller scale, during his first term. Back then, he intentionally weakened the dollar to gain leverage in trade negotiations. Tactical, calculated, effective. But this time, the stakes are so much higher. And we've just received a bombshell update from macro investor Raoul Pal. This is big. Stay with me. Take a listen to this 2-minute clip from Raoul Pal. Full link is in the description, where he breaks down why China may have no choice but to start printing money. We're talking full-on quantitative easing.
Why they'll be
and once
forced
that happens,
to negotiate
China
with
will
the
be
United
back at the table. This mirrors what we saw in the 2017 trade standoff. And here's the kicker. When the dust settles, Bitcoin could come out as the biggest winner.
China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now. They're in a full debt deflation. And China's going to be very important to this story. And it's the most important headline that is going to come is what the agreement is with China. So the agreement with China will be, and I've been talking about this for a year in Global Macro Investor and Real Vision Pro Macro, the agreement with China will be, you will agree to tariff terms, we will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem. The Chinese have a dollar debt problem and they need to service those debts. The problem is the RMB is too weak and the dollar is too strong. They don't have the cash flows in a slow economic environment to pay for it. They know, the US knows. Yellen even went to talk to them about it when she was still at the Treasury. They need a weaker dollar. Now, the mechanism by which China gets access to those dollars is usually via the euro-dollar market, and it's Japan that is the big driver of the euro-dollar market. So when we look at the weakening of the dollar, I like to focus on dollar-yen to think of how this plays out. The yen is one of the world's big exporting economies, and it has a very weak currency. The yen needs to strengthen, and a strengthening yen and a weakening dollar will allow capital to flow into China and other dollar borrowers via the euro-dollar market. And the key thing that happens here is this chart of the Chinese currency against the yen. The Chinese currency was too strong versus the yen, and that has been putting pressure on Chinese exporters and the Chinese economy. It needs to rebalance lower, and this head and shoulders top and this head and shoulders top tell us the US, Scott Bessent, is going to get what he wants.
Which is exactly why Treasury Secretary Scott Bessent has been so vocal about China's next move. It's all part of a larger macroeconomic chess game.
Scott Bessent is going to get what he wants, which is a weaker dollar. A weaker dollar will stimulate global demand. It stimulates and allows for the rolling of global US dollar debts. It allows for exports and imports to free up. It allows for the movement of trade, even with tariffs. It's a very big deal, the dollar weakening. And if China can have a weakening yuan, a strengthening yuan, or weakening yuan against the yen, what it allows them to do is to compete. And that rebalances global trade and gets the global growth cycle going.
Now, you might be wondering, Sam, why would China fall for the same move twice? Haven't they learned from 2017? Great question. But here's the truth. The US still holds the ace up its sleeve. The US dollar remains the world's dominant reserve currency. That gives America unmatched leverage in global finance. And for now, that edge still holds.
This is exactly what happened last time when Trump was in power in 2017. What we had was called the Shanghai Accord. It was a kind of public, not public agreement to weaken the dollar to allow the Chinese to stimulate, because they need a weaker dollar to stimulate because they don't want to weaken their currency via the currency band, because if not, you get a devaluation, which they do not want. So that was the Shanghai Accord then. The dollar fell dramatically and the Chinese stimulated massively. If you remember 2017, the Fed were raising rates. They were shrinking the balance sheet, but China and Europe stimulated. And that was via this mechanism.
So when in doubt, zoom out. Take a long view on Bitcoin. Remember, even back in 2017, when the Fed was raising interest rates, Bitcoin exploded. Why? Because China was printing. Patterns repeat. And if you want the edge in navigating this market, hit that subscribe button. I'm Sam, and I'll catch you in the next one.